Welcome to Dr. Fred Markets. This is not financial advice. Every day, billions of dollars move across markets that most people don't even know exist. Crypto, stocks, AI, the signals are there if you know where to look. And that's exactly what we do here. Let's dive in.
Your vending machine stock is secretly a global debt dealer. Stock futures are green into the Fed meeting. S&P down 1.25% yesterday. Nvidia down 1.33%. Nobody asks the real question. Who actually gets paid when money is tight? Signal 1, Monster Beverage. Ticker MNST. Drinks that rot your teeth. 33% net margin, almost zero debt, over $60 billion market cap. Over the last 20 years, it turned $10,000 into roughly $1.5 million. That's not a stock, that's a money printer wearing a skull on the can. Signal 2, Celsius Holdings, ticker CLH. Revenue up triple digits year over year, gross margin north of 45%, slapped its brand straight into every gym selfie on earth, and now trades at a valuation fatter than legacy soda giants. It isn't just selling caffeine, it's selling productivity fuel to a workforce terrified of being replaced by automation. Signal 3, Global Consumer Debt. Household debt in the US over $17.5 trillion. Worldwide energy drink market around $90 billion by 2030 if growth holds. Tiny by comparison, right? Wrong. That $90 billion sits right at the choke point, stressed out workers, rising rates, and corporate profit margins. The more the Fed fights inflation, the more your boss squeezes you, and the more you swig these cans to survive. Here's the cliffhanger. Everyone stares at Fed minutes. Almost nobody tracks the businesses that literally monetize your burnout. Put these three signals together, and the picture is disgusting and beautiful at the same time. Energy drink stocks are a leveraged bet on human stress in a high-rate world. When rates go up, corporate pressure spikes. When corporate pressure spikes, caffeine consumption jumps. When caffeine consumption jumps, Monster and Celsius don't just sell more cans. They jack up pricing, expand distribution, and negotiate better shelf space while their marketing pretends it's fitness. You are watching a transfer mechanism. Central banks crank rates, corporates squeeze productivity, workers self-medicate with legal speed in a can. Investors in these brands skim the spread off every all-nighter, every gig shift, every please log on this weekend. That is the cash flow conveyor belt nobody wants to talk about. This is where today's macro headlines actually matter. Fed decision coming, futures green, tech wobbling, everyone obsessed with Nvidia's minus 1.33%, like that's the whole show. Meanwhile, energy drink companies barely care if Nvidia misses a beat. AI booms, AI busts. The human body still needs a crutch at 2 a.m. in a warehouse or WeWork.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
Here's the one thing you learned today. Energy drink stocks are stealth stress derivatives on the modern job market. Not a fun consumer play, a liquid index of how desperate people are to keep their seat. Mechanism time. Step 1, rates stay higher for longer. That keeps pressure on companies to deliver earnings growth without cheap debt. Step 2, companies push harder, understaff, overwork, do more with less. Step 3, humans hack their biology with caffeine and stimulants to keep up. Step 4, energy drink sales accelerate even when broader consumer spending slows, because this isn't treat spending, it's survival spending. Monster's 30-cent plus operating margin in a grocery aisle business tells you one thing. This is not just branding. This is monopoly pricing on human exhaustion. Celsius riding the fitness trend isn't health, it's anxiety in a pretty can. When you see margins that high with marketing that aggressive, that's your signal. They own the habit loop. So what does this mean for you? First, stop being sentimental about markets. These tickers don't support athletes or fuel ambition. They tax fatigue. When S&P concentration risk scares you and Nvidia looks frothy, there's a boring little oligopoly in the drink aisle quietly taxing every late shift. Second, if you want exposure, think like a parasite, not a fan. Read the 10Ks. Check volume growth versus price growth. Are they selling more cans or just charging more per can? Track distribution deals, especially with big box retailers and convenience chains. Follow advertising spend as a % of revenue. When they're spending big and margins stay fat, the habit is locked in. Third, and this is the uncomfortable part, your personal life is part of their forecast model. The more you depend on caffeine to tolerate a job you hate, the more predictable their revenue stream becomes. That is the real moat. This is not financial advice, but here is the truth. 1. Energy drink stocks are not lifestyle brands, they're stress tax collectors. 2. Higher for longer rates and job insecurity are the fuel for their next growth leg. 3. Your edge is to see them not as fun consumer names, but as a macro instrument on human burnout. You decide your role here. Drink the product, own the stock, or change your life, so neither is necessary. If you learned something, subscribe. Tomorrow, we tear apart the next lie Wall Street sells as lifestyle. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.